Breakfast Clubbers. Today we have the distinguished opportunity to hear Mike Kress and Nicholas Atkeson. And Mike, you are a wise guy. You've been around for a long time. You're smart. You've had decades of experience. We love hearing your economic outlooks, and we're looking forward to hearing what you and Nick have to tell us this morning. Please go ahead and let's introduce Mike Kress.
I'm going to introduce you to Nick Atkeson, who is Delta's chief economic officer. And he didn't learn all this economics academically. He learned it in the trenches at Montgomery Securities. So take it away, Nick.
And I'm going to talk to you about the Delta outlook for the economy and the stock market for 2021. Sitting behind me is Andrew Houghton. He's my business partner. There's Andrew. There are others that actually show up in this room, and we have offices actually all over the country, so it's bigger. But we've been working with Mike for years. Mike's been publishing an indicator. We have an indicator collectively today called the Delta Market Sentiment Indicator. And every week we put out a number that says whether we think the market's bullish or bearish on an intermediate term basis. And it's actually published by Barron's, the magazine. The same magazine is published by the Wall Street Journal, and it's been in there for years. The point of that is to say that we also publish a newsletter that you can subscribe to that comes out weekly by email, goes to your email address, and you can always unsubscribe. But basically it gives you a quick commentary, sort of our current thoughts for the week about whether we think things are good or not good or where we're going. And also it has the Delta Market Sentiment Indicator, which Mike uses to manage money. And if you have an interest in it, and I'll repeat this information again at the end of the presentation, you can email info, I-N-F-O, at deltaim.com, Delta Investment Management, deltaim.com. And just indicate Breakfast Club, add me to Delta newsletter, and we will do it. All right, let's go. Whoops. Okay, we have disclosures. I guess they basically say take everything with a grain of salt. Delta is mostly a tactical money manager. As you know, Mike tries to participate in bullish markets by being invested in the strongest assets, the best stocks during bullish runs. And when risk is elevated, we try and reduce exposure and avoid the major downturns. He's had a long history of doing this successfully, and that's basically our philosophy. We're not going to sit and take the beating, particularly the market's going to be down a lot and for years. We'd rather be out and looking for a chance to buy than being in and wondering when we're going to sell. Okay, so this first chart I'm sharing with you is showing the market returns, calendar year returns without dividends for the S&P 500 from 1980 through 2020. And the gray bars are the calendar year returns, and the little numbers on top of the gray bars are the return. And then you'll see little red numbers below, and what those are is the drawdowns that occurred during the year. And you see that drawdowns are common. Every year we have some pullbacks, and often the pullbacks are, -8, -9, high single digit type pullbacks. There's some red circle areas. Those are recessions. And in recessions, the pullbacks are much worse. -30, -34. Last year we had a -34 during the COVID crisis. 2008, down 50. 2000, the total drawdown was about down 50. 1973-74 recession, down 50. In the non-recessionary years, and those are marked with sort of those green horizontal bars, again, the drawdowns are much less, and in almost every year you get a nice positive calendar year return. So one might say, and you're asking, what we're presenting here is our economic outlook, so I'm going to stick to sort of macroeconomics. One might say, well, if recessions are bad, are we able to predict them and avoid them? We use two measures primarily to determine if we're likely to go into a recession. The first one is the leading economic index, abbreviated LEI. And this is published monthly. You can get it off the internet. It's from the conference board. And you get this series of percent change from the previous month. And the question is, what do you do with it? And what we've determined is the 6-month moving average of the LEI. When that turns negative, there's a good chance you're going into recession. It's almost always the case. It's a very robust indicator. The chart I have up is showing sort of that month over month change in the LEI. And you can see in the COVID period, the first and second quarters of 2020, we had an absolute collapse in the LEI. But since then, and this is the part we care about, we've had a nice recovery. And the 6-month moving average of the LEI is positive. I show that again, just sort of in a line chart, and this is the 6-month moving average. You can see it drew down very sharply, and we had a very brief recession associated with the COVID shutdown. But it's come back, and right now, at least from the standpoint of the leading economic index, 6-month moving average, it doesn't look like there's much of a chance of recession. The other indicator we use to determine if there's a chance of recession is the yield curve. And we mean by that the US Treasury yield curve, and we compare the 2-year rate versus the 10-year rate. And if the 2-year rate is higher than the 10-year rate, we call that a yield curve inversion, and that's a very negative sign, and there's a chance of recession, very elevated. Now, before the COVID situation, late 2019, early 2020, there's a lot of talk about the yield curve and it being potentially inverted. There were some days in August of 2019 where it did invert for a few days on a 2- and 10-year basis, but the talk that was going on was a lot of talk about the 1 month and the 3-month and other. So just to be clear, Delta looks at the 2-year and the 10-year, and in our view of it, that is by far the most robust way to use the yield curve as a measure of recession. But the takeaway from the yield curve is it has a nice upward slope. That's good. That indicates very low risk of recession. So we don't think there's a recession coming. And once you take the recession question off the table, the way you invest changes. If you were fearful of recession, you'd be pretty defensive. But when there's not a recession, you have a little more leeway. You have tailwinds instead of headwinds, and so you can be more aggressive in your investment profile. Okay, the other positive about what's going on in the world today is that we had a monster earnings drop off for COVID, but it appears it's coming back quite strongly. So in 2021, the consensus analyst estimates for S&P 500 earnings growth is up 23%, and for 2022 it's up 17%. And on the chart that hopefully you see on your screen, that's these 3 light blue bars. And you can see we're coming out of a bit of a hole, but we're going up to new highs on earnings. So you've got global growth, you've got US economic growth, and you've got your earnings growth. That's the good stuff. And by the way, the next chart just shows that sort of record number of companies are beating estimates, both the revenue line and the net income line, the top and bottom lines, and they're raising guidance. So that's encouraging because it suggests that the estimates that are printed today are probably going higher. Another positive from an investment standpoint and an economic standpoint is this record amount of liquidity that's been pumped into the financial markets. They talk about the $3 trillion of US Treasury money flow influx into the economy through buying bonds. That's ongoing. They're and I forget the rate, but it's in billions of dollars a month, 80 billion, I think a month is, but don't quote me on it. But it's very aggressive liquidity being put into the market. On top of that, I'm going to see what the next slide is. Okay, so on top of it, and this may be slightly out of order, but the assumption by the financial markets with Biden being elected is that there'll be more stimulus sooner. There might be a multi-trillion-dollar infrastructure bill, but the point is lots of fiscal stimulus on top of the monetary stimulus, meaning more money being thrown at this. Personal savings rates are hitting, the highs since World War II. There's just a lot of money out there. I think that it was quoted as something like $5 trillion in money market funds, which is, multiples higher than what it is normally. So there's a lot of liquidity. Okay, so that's the good news. Here's the difficult news. And this is, I think, is an issue that we're going to go through in some detail. So the chart I'm showing now is the S&P 500 price index, and overlaid on it are the PE of the market. And so before COVID, we were trading at a PE of 19 times on the S&P 500. That's February. That was the high PE, February 19, 2020. We dropped to a very low PE, about 13 times. Clearly, that was a good time to buy at the bottom in March 23. And now we're trading at 22 times. And 22 times is historically an elevated number. That's a number that some people might be concerned about. So valuation is up. This next chart shows where the market did well in 2020. And basically the story is large cap growth. Are just, growth overall vastly outperformed value. Growth is very strong, but so in essence, what happened? Well, COVID shut down, the regular economy, airlines, cruise ships, restaurants, hotels, anything we did in person, and it pushed the economy online, and that benefits these, new technology growth companies, and particularly the large ones. So it's not a surprise with everybody being forced to shop at Amazon that Amazon did well, and Google did well, and stayed at home and watched Netflix, and Microsoft supported a lot of this, and Apple did well, and that's not a surprise. And it's not a surprise, Carnival Cruises nearly, suffered a lot. Now, by the way, what's interesting on value is a lot of these companies that had very tough times were able to access the capital markets and get capital to stay afloat, which is different than 2008. So in 2008, we had issues where companies couldn't get capital, and there was a very big risk of major defaults. We haven't seen that in this crisis, in that many companies that were, businesses went to zero, were able to go out and borrow money and have stayed afloat so far. Okay, so the next chart shows value versus growth relative valuations. And this is just a chart showing sort of the magnitude at which value has gotten inexpensive relative to growth. So that's, this is suggestive of the idea that during 2020, growth was the leader in 2020, and in 2021, it may be time to start migrating more into value in that you get an economic rebound with further reopening, the vaccine, whatever. And this also just says on a relative valuation basis, if you're worried about high multiples, go buy value. Okay. This next chart, again, just reinforces the idea that the top 10 biggest stocks have become a very large part of the stock market. In fact, the weight of the top 10 stocks in the S&P 500 right now is 28.6%. Now, from an earnings contribution standpoint, it's only 23.7. So you could say they're bigger than what they're hitting at. In other words, you would think if they were only 23.7% of earnings, why are they 28.6% of the index? That's because their multiples are higher than the average in the S&P 500. Okay, The next chart is about showing inflation. And this is a chart that comes from the Federal Reserve, and it shows expected inflation over the next 10 years. And right now it's at 1.72%. Currently, inflation is running well below that, about 1.3%. But the expected inflation rate over the next 10 years is 1.72. The 10-year Treasury rate is 1.1, rough number. So when you take the Treasury rate and you subtract the expected inflation rate, you get a negative number, 1.1 minus 1.72, meaning that the real interest rate is negative. It's unusual for the real interest rate to remain negative for long periods of time. So either inflation's too high, the expectation, or the nominal Treasury rate is too low, or some combination, but it's likely over time that real interest rates will go back to being positive, not negative. And the next chart shows the 10-year Treasury rate, the last 3 months of it, and you can see we've just had a 22% increase in the 10-year Treasury rate in the last week. So the interest rates are moving up rapidly. Market determined interest rates. Now the Federal Reserve is keeping the short rate, the Fed funds rate, essentially close to zero, but the market helps determine what happens in the longer rates, and that's just jumped 22%. And a lot of that jump, we think, is because the Democrats took the Georgia Senate seats. You have Biden in the White House, so you have more Democratic control, meaning more fiscal spending than otherwise, and that might be inflationary. So this thing is telling us that inflation's not probably coming down, and nominal rates are going to go up. The reason why that's of interest is that when interest rates rise, the discount at which we discount future stock earnings and dividends back to today, that discount rate rises. And when the discount rate rises, stock values decline, or the PE multiple contracts. So if you have very high multiple stocks, they might be more at risk of a rising interest rate than lower multiple stocks. So you have a number of things going on. You have high growth stocks that had this acceleration in growth because the bricks and mortar competition got shut down. So they had this rapid move online because of COVID. Two, you have, so as the economy opens up, this accelerated growth into these online stores is going to de-accelerate. The growth is going to stay positive, but the growth will come in at a slower rate than it had last year, most likely. The second thing is there are elevated multiples. You're going to be having the potential for PE contraction. And then on the other side of the coin, you have these the bricks and mortar or the regular economy stores that have been totally out of favor and completely shut down. They're going to be beginning to open up. So that suggests again that you might be looking more to the value side of things. And we're seeing some of that. The energy sector lately, which was the worst performing sector in the S&P last year, has been putting on very, very strong relative appreciation. Okay, now I'm going to talk something about sort of the bigger picture, taking a longer term view of the world, and kind of explain sort of the underpinnings of the US stock market in a bigger, from a global perspective and from sort of a change in structure perspective. Things are changing. Okay, so we all grew up at a time when we thought of business cycles, and there was a cycle where you went up and then you went down and you went up and you went down, and and so what I have a picture up now of is basically the US, basically businesses, not including information processing equipment, intellectual property products. In other words, not including the new tech. And there you see a basically business cycle. You see it go up, and you see it come down, you see it go up, you see it come down. And that's how that's how we thought about investing. You ride the ups, avoid the downs, ride the ups, avoid the downs. Okay. Now I'm showing you a slide that shows in red new economy spending on information processing equipment, intellectual products, property, and products. Okay, that's big tech. And in 2000, big tech was small. I mean, I don't know if any of you bought anything on Amazon in the year 2000 or 2002 or 4 or I don't know. But today, big tech information processing is more than half of all economic spending. I mean, of capital spending, business structural spending. It's 54% of total. In other words, think to yourself, what businesses are slowing down on spending on technology? No one. We're all buying computers, software, this, that. In fact, with the exception of a very small dip in 2008, this red line that goes up is basically straight up. And as technology becomes an ever increasing part of our economy, and it has no cyclicality associated with it, our whole economy, our whole business cycle becomes less cyclical. That helps understand why the stock market did pretty well last year. The stock market is becoming more and more in the United States of America a big tech stock market, and it has very little cyclicality. You can blow the world up with COVID and still plow right through it from a stock market standpoint because all the money is in this area, which has very low cyclicality. So after spending time telling you that big tech is expensive, growth is expensive, there are reasons for it. And the big reason is that it's very steady. It's got good earnings visibility. We're not gonna, when COVID ends, we're not going to stop using Amazon. We're not going to stop, looking at things on Netflix. So there's growth there, and you pick your buy points, but that area is strong. It may just be, richly valued currently, but it's not like that's a bad area. Okay, now, and I'm just going to sort of reinforce those points. If you look at revenue growth, S&P 500 overall versus tech, so this chart I'm showing is S&P X tech revenue growth, which is the gray line. The blue line is tech. You see all the revenue growth is in technology, the much slower growth without the tech. If you look at margin expansion, there's no margin expansion outside the tech area, but the technology firms are experiencing margin expansion. So that's very powerful. When you have revenue growth plus margins expanding, you get very good earnings growth. Again, another reason why this big cap tech is highly valued. Another thing I'll say is that if you compare 2000 to today, it was unclear who the winners were in technology. But today it's pretty darn clear. Facebook is the social media company. Google is the way you get on the internet. Microsoft is still dominant in business computing. When these companies become, it's 2 years ago, we didn't have $1 trillion market cap company, and now we have several. When these companies become $1 trillion+ market cap companies, they dominate their sectors, they're virtual monopolies. You can argue there's a good reason for these things to have a higher PE multiple. So we may be, we have low interest rates on an absolute basis. We have very, very large dominant companies. They're able to buy up their competition. The barriers to entry are enormous. It's not that the PE multiple of 22 may seem high on a historic basis, but there are good reasons for it. So it's not the end of the world. So we're not going to let the PE multiple make us bearish. So to sum up, what do we think for 2021? You have 23% earnings growth. You do have rising interest rates. So, there are formulas we can put this stuff into, but not to bore you with sort of the mathematical technical detail. Basically, we think you're going to have a decent positive year on the market, let's just say range bound 8 to 12% up, something like that would be a best guess because of the earnings growth. And there could be some multiple contraction in big cap tech. The other thing that's going on in big cap tech is regulatory oversight is rising. They're reviewing, if you have a platform company and people say bad things on your platform, is the platform liable? That's the current issue that's being discussed. And so there could be that type of thing that would make the nature of the business less attractive. But generally, we think we're going to have a good year. And, if there's something to look at, you might be looking at more of these sort of very down and out of favor stocks that are trading at good valuation, and play that side and play the sort of the 12 to 24 month reopening process. So that's the outlook in a nutshell. Again, we manage accounts using these kinds of thoughts, and then we have that newsletter, as I mentioned, and we like to get the newsletter. And we, like I say, we try and keep it short. We have a cartoon in it, and it keeps you up to date as to what we're thinking in case we change our minds.
So Nick, the newsletter, then we just go to the Delta Tactical website and we can sign it up for it there.
Yeah, you can sign up at the the deltaim.com website as well.
Okay, Delta IM. All right, great.
Yeah, www.deltaim.
Great presentation, by the way. I burned through a couple pages of notes, and I know that this is recorded, but just your slideshow and everything was like just really, really helpful. Let's go ahead and open it up for questions. Bert, I see you're waving your hand. Why don't you?
Yeah, I got a question. Mobility as a service, replacing our transportation system, single occupancy driven vehicle to where it's a service. I know that all the car makers are heavily invested in this area. Would you consider that to be tech, or because there is a component of restructuring the infrastructure and everything around that kind of a service, is it a combination?
Well, there's no doubt that at least it's a combination, right? I mean, I think people don't look at Tesla as a car company. They look at it as something else. I mean, it's the only way it could go up 9 times last year is that it's got something else going on. Translation, it's a technology company. So I think this mobility as a service is a tech thought. The question is, will it ever help Ford or GM? I don't know. But you see people put a premium on the idea. As soon as you label it tech, new thing, add to the multiple points.
So the general survey it's fairly, it's positive for 2020 and positive, sounds like positive expectations for 2021 is what you're saying.
On the earnings estimates, yes.
So we should all be invested in tech. Is that how we should diversify our portfolio?
So I was suggesting something else. Basically, you have holdings in tech. That's great. That those secular trends are in place, but maybe the opportunities this year are more value-based or smaller cap or places which haven't run so much.
All right. So let me ask you just real quick advice on, should I invest in Carnival Cruises right now? Because they have nowhere to go but up, or unless they sink, then that's the other thing.
Yeah, so we're prohibited from giving you specific security recommendations. Buy. That's what we said. Buy.
All right. Anyone else? Bill Buchanan.
Good morning, Nick. Thanks very much for your, presentation. It's always good to hear a little bit of positive news in this gloomy world, for God's sakes. A couple of questions for you. Number one, who are your clients? That's the question number one. Number two, I thought I saw on the cover slide, AAII. Does that stand for American Association of Individual Investors by any chance?
There? Oh yeah, you're right. You saw it in the upper right-hand corner. Oops.
Yeah.
Yeah, okay, that does stand for American Association of Independent Investors. We give a lot of presentations to them at their national conference.
Yeah.
Our investors typically are, individuals.
I see. Okay.
But we have all types. We have corporate accounts and pensions, and the accounts can be individual, IRA, trust. It does, the whole range.
I see. Thank you.
Nick, do you guys have a minimum entry point for your client base?
Well, here's the good news. Our entry points are low, meaning $50,000, because we'd like to get people in, and when they see what we do, our experiences, they add to the account.
Okay. It looks like Tony Woodall has a question, followed by Hugh Tuck.
I have to unmute my own self. I have a quick question. Nick and Mike and the folks there at Delta Investment, what, in light of the pandemic and the political changes that we're going through, what keeps you up at night now with those things in mind for the next year as far as investment and financial markets?
Well, honestly, nothing's keeping me up at night, but the except that I'll just say, I think that, when you watched the news in 2020, it was pretty depressing. Deaths, hospitalizations, things being shut down, whatever else. I think people are coming into 2021 sort of with this feeling of, oh, it can't be worse than 2020. It's going to be great. Everything's going to be great. 2020 from an investment standpoint was a pretty good year. The S&P was up 18.4%. So 2020 wasn't as, forgetting the deaths, forgetting COVID, forgetting many restaurants don't exist anymore. You can't get your hair done in San Francisco, whatever. It was a good year for investing. 2021 might be a better fundamental year, meaning the economy's reopening. There's healing going on in terms of just generally what's the vaccines being distributed, all that. But it might not be as good an investment year, meaning interest rates are rising. We're starting the year at a much higher multiple than we'd started at 2020. So just because it's a better year fundamentally, I don't think we're going to see an 18% return in the S&P this year. I think it's going to be positive, but I doubt we're going to back-to-back, be at that level or higher. So, but that doesn't mean it's going to be a bad year. It's a fine year. It's going to be a catch-up year for the stuff that's down and out. The growth stuff will plod forward. And, one of the things that's very powerful is this amount of liquidity that's been pumped into the market. We have trillions and trillions of dollars that have to be put to work, and interest rates are, again, even having been up 20% in the last week, they're still very low. That money's got to go somewhere, and a lot of it's going to go into equity.
Okay. Thank you.
Okay. Mike Milstein. Oh, Mike, you're muted, by the way. And Hugh, Mike, go first, and then we'll circle back to Hugh.
Good here. Okay, Mike, my question is this: you're anticipating the market's up or down. When you anticipate the fact that the market might be going down, what's your normal recommendation? Do you move into bonds, or do you just go into cash, or what is a typical recommendation when you're anticipating a down market?
Okay, so the first thing I'd say is, people love to make predictions, right? And we all know how good those are, particularly as you extend out over time. So we look at the market every single week, and that's this Delta Market Sentiment Indicator. So we're very comfortable this week. We're bullish. That might sound crazy, but that's our confidence in the market is we look at it every single week, and we're willing to change on a dime. Now, when things start to look risky and not so good, we basically will go to cash. In our experience, trying to do much else usually is a losing approach. And the beauty of cash is when you go into a big crisis, you have cash. You don't have to get out of something else to get into something. You already are ready to make that move. And that's very powerful when everyone's a seller and you're the only buyer.
All right. Thank you. Hugh, are you still there?
Yeah. Just what do you think of Bitcoins?
I miss every hot trend. That's my job. I just miss them. I don't know. I really don't. I don't have, Bitcoin ripped up. It's had a big pullback. At some level, I've learned, even if I don't understand it or want it or whatever, sometimes I just have a little holding in something so I have some exposure. I don't know. I wouldn't even know how to. There are Bitcoin ETFs, so you can buy Bitcoin ETFs. There are a couple of them. So there are ways to get exposure through an ETF. But I don't have a hard opinion about BTC. I'm not a believer that the US dollar is going away. You know, I think Bitcoin over time, or any kind of electronic currency has to, will eventually get regulated in some manner. But I don't have a, it's very possible that 20 years from now, Bitcoin's the thing. I don't know. So.
All right, good question. Nick, I'm keeping an eye on the clock right now. It's 8:49. Can you stick around for a few more minutes and answer questions?
Okay.
If you're good. Betty, did you have your hand up, Betty?
No, I was going to ask about Bitcoin, and thank you for an excellent and very clear, concise, articulate presentation, because this can be so overwhelming. And I actually followed it most of the way until toward the end. But so that meant a lot to me. So thank you very much, Nick. Great presentation.
Thank you.
We have any other questions?
Yeah,
Michael, again,
just
part two.
follow last question, Mike. In a down market, you get involved in selling short?
No.
You're not involved in that.
No.
Okay. All right. Good.
Short sell. My philosophy on short selling, after studying this for a long time, is short selling is successful when you have specific information on something specific in a specific period of time. It's like options trading. If you just feel that the market's going to go down and you put out a short, there's a good chance you're going to get hurt. You could look at all the people that shorted Tesla, and the thing was a monster. Went up 9 times last year. It crushed the short. So at one point, it was the most heavily shorted stock in the market just a year ago. So the problem with shorting is that there are people that do it well. And those people, what they do is they study something, a company specifically. They have very, very good information that is not priced into the stock. They have a time period for which it's going to play out, and then they short. But just to go put a big old short out on the market, I mean, would you have thought the market would have been up 18% in March last year when we were in the midst of COVID? I mean, nobody would have thought that, right? Let's say the market had gone up, recovered and was break even. You might have. So whatever we're thinking at the time, it's not enough information to be a good short seller.
Okay. Thank you.
All right. Bill Buchanan, and do we have any other questions?
This is more in the form of
I beg your pardon?
more in the form of a comment for Nick. Nick, you mentioned the Bitcoin, and I recall that several years ago, Alan Garber and I were getting off the elevator on the 10th floor because the speaker was an expert on Bitcoin. I said to Alan, hey, this is great because we heard all about this great investment opportunity. We'll learn about it, and then we walk out, we'll be able to act, perhaps. At the end of the presentation, Alan and I were getting into the elevator to go home. I turned to Alan, I said, hey, do you understand Bitcoin now? He said, I have no idea what the hell it is. So anyway, your admonition to not, invest in anything you don't know about is well taken.
Great. Thank you, Bill. Look, we're almost out of time here, so why don't we go ahead and thank Nick and Mike Kress for joining us this morning. Really just fantastic presentation, you guys, and really we appreciate you taking the time.